If you've been following us uh, over the last few quarters as we've been doing these, you will notice that I finally am off the folding table in my living room. So it's exciting.
That is exciting. You finally got the office fixed up, which is good.
Exactly.
So, but yeah, it's good to be back in Philadelphia. It seems to be a little bit more vibrant. They've opened up the city a little bit more. I think we're up to 50% now, which is good. Um, and I do hear that today, I think just today, they announced that they're going to open up New York City full blown by July 1st, which is pretty interesting. But um, the mayor has to get Governor Cuomo's approval to get that done. So who knows what's going to really happen. But there is a lot of exciting things going on. So Dan, if you're ready to get started, I'll cover a couple of things here. And one of the things that I picked up today is very encouraging. From an article today that the U.S. economy has grown at 6.4% in the first quarter, and even expects to even grow faster in the months ahead. So there's a lot of data in this article. I can touch a little bit about that as we go through the meeting. Dan's going to talk a little bit, talk more about the topics on the market commentary. Now, Dan, I think you did a great job. And if everybody doesn't know how we put this market commentary together, what we do is about a month before, a couple of weeks before actually the end of the quarter, we'll all sit down. The whole office will sit down, and we've all read a bunch of articles and magazines and books and things like that throughout the quarter. And we put things on the table, and Dan will select through a couple of different articles that he likes. A lot of times he picks his own out, but he does pull some articles that we put on the table that may fit into what he wants to say. But then Dan goes ahead and writes the commentary, and he does a fantastic job. We all know that I can't write, so it's better that he does it than I do it. So, but he did a fantastic job this month and last quarter actually. And then we're gonna step into giving you some updates on what's going on with our portfolios. We have some of you are already realizing what we're doing, but we got some additions to our portfolios that we're going to talk about a little bit. And then we also got a few additional thoughts on real estate market. If you haven't been paying attention, the real estate market has been going up fairly aggressively over the last 12 months. Actually, the real estate market jumped 11% just in this past quarter, or past, I think it was the past 6 months, it jumped 11%. So there's a lot of interesting things to talk about today. If, like Dan said, in the bottom part of your screen, there's a chat. We will be picking up on the chat, and I'll throw it out to Dan, or or Dan will throw it out to me, depending on what the question is. So, so just to touch on before Dan steps into the quarterly commentary, again, the economy grew at 6.4%, which is fantastic.
Very encouraging.
Very encouraging. And the more Americans get vaccinated, we're seeing people becoming more getting out in the world a little bit more. Fewer people are catching coronavirus, and Washington approved another $1.9 trillion stimulus package that most of it has yet to hit the economy. Gross domestic products rose, as I said, 6.4%. Consumer spending surged by 10.7% in the early part of this year. And that's also helped by the $2,000 stimulus checks that a lot of people received in their bank accounts that was sent directly by the federal government between January and March. The interesting part is I had a lot of clients call me up and say, why did I get this stimulus check? And the main reason is because we didn't do a required minimum distribution. So that didn't show up on their tax returns in 2020. So a lot more people got the stimulus check than actually was expecting it.
You have to remember, the federal government knows how much money you make. They don't know how much money you have.
That's a fact. That's a fact. the other part is the private sector is ramping up spending too. So business investment jumped about 10%. Big picture, the economy was bound to speed up once again once vaccinations did their job. About 43% of the population so far has actually received the vaccination, and GDP is now forecasted at 8.2% in the second quarter of this year. I just found that article was just a very, very interesting article. And Dan, does the Roaring Twenties mean anything to you at all?
It does. Uh, yeah, and hopefully we're in for a repeat performance a century later. Um, I'm gonna click through this here. So this is where the Roaring Twenties would have to come from. So I don't know if anyone has heard this term yet, the Goldilocks economy, or the Goldilocks market. Um, it's becoming a little bit of a more popular term with among journalists and analysts and the like. It came from the annual letter of the CEO of J.P. Morgan Chase, Jamie Dimon. He sends out an annual letter every year, and he talked about the Goldilocks economy, which really is we all know the story of Goldilocks, too hot, too cold, just right. But the point is that for the next step for the market, for the economy to get it just right is going to be essentially avoiding, two different bears, if you will. So, the too hot would be inflation, right? So, and typically, when we talk about inflation, economists are uh, referring to price inflation, consumer price inflation. But we may be talking about asset price inflation. Rick was referring to the real estate market. As we know, real estate prices are very high. Another thing in the too hot camp would be bubbles. So, debt bubbles, whether it's real estate debt, student loan debt. What does that mean for the economy? And just in general, when you print a lot of money, it's going to create pockets of growth that can't be sustained, and those bubbles could pop. On the flip side, the too cold economy is, and it looks like we are sort of forcibly avoiding this due to the expansionary monetary policy that we've been seeing. But the too cold economy is the exact opposite. It's recessionary. It's GDP contracting. It's falling bond yields, which we have seen falling bond yields. So, that's still a concern in the sense that bond yields, especially longer term, give us a sense of uh, sort of the implied growth prospects over the long term. So, falling bond yields obviously are still something that does raise concern, because in order to stoke growth, keeping rates low isn't attractive over the long term. We want to see economic growth due to productivity, not just because money is cheap. So essentially, in order to get the next step just right, we kind of have to reconcile the two. The Federal Reserve can't keep just printing money, and the federal government can't just keep spending their way out of what would likely otherwise be a recessionary environment, due to the shutdowns from COVID. Um, and I think a lot of investors are kind of looking at it this way too. We know the market has run up significantly, and, and everyone's kind of a little nervous. But interestingly enough, there's still signs of optimism. And I put in the commentary, why is this not moving for me? There we go. Excuse me. I put in the commentary this quarter something called the Fear and Greed Index, which is something that's tracked by CNN Money. It's a proprietary index that they use. And I know Rick's going to talk about this a little bit more later about Warren Buffett, but one of the famous Warren Buffett quotes is to be greedy when others are fearful and be fearful when others are greedy. And so I love looking at this fear and greed index, and what we've been seeing is that it's hovering around, it goes from 1 to 100 or 0 to 100, and it's been hovering right around 50 pretty much all of 2021. Which essentially, means investors are undecided. Are they fearful or are they greedy? There's reasons to be fearful, as we talked about. The market has run up. You kind of have that lingering feeling of what goes up must come down. But then again, all of the uh, all of the conditions that have created the incredible growth we've seen over the past year are still intact. So there's still reasons to be optimistic. And this particular index that CNN Money puts out, what they do is they take, I think it's 7 different metrics to gauge how fearful or greedy investors are, and they rank it from extreme fear to extreme greed, and somewhere in the middle is neutral. So when they kind of do a weighted average, and they say, and you can see from this chart here over time, what's dominating the market. Is it fear or is it greed? So as an example, when COVID first hit, you can see we were trading at investors were really, really optimistic up here, and then all of a sudden, not so much. And we've obviously seen a good recovery there, and this also tends to follow the movement of the market. So I think as you saw the market coming back, investors got a little bit less fearful. But it's kind of gotten to a point where everyone's just kind of sitting on a fence, and we're seeing that there's pockets of both extreme fear, which is coming from safe haven demand, meaning the demand for treasuries, the demand for CDs, stable assets is at a high, which would signal extreme fear. However, there's also signs of extreme greed, which is seen by market momentum and trading volume. So we're seeing kind of both sides of it. And there's it's sort of black and white. You're completely out of the market, you're in treasuries and cash, or you're all in and you're just going for the ride. So we're seeing pockets of both, and at the end of the day, investors sort of are undecided right now.
And I remember that day you had down there, Dan, where the bottom of the arrow was. I think that was March 23rd, 2020, where capitulation happened and the market started going back up. So that was the bottom.
Yeah, and that was a very, like I said, we were at a high in terms of investor greed, if you will, was at a high, and it just plummeted. I mean, it was, yeah, over 30 days, like you said, through March. Hasn't quite come back to pre-COVID levels, but the fear has mostly has subsided. But here's the reason I think that investors are sort of undecided. So just a quick kind of crash course in economics. Typically, what happens is fiscal injections are occurring when there's something called an output gap. In other words, when the actual GDP, Rick talked a little bit about GDP at the onset, but it's when the actual GDP is falling short of the potential GDP. So as an example, and this is in the letter, in the Great Depression, the output gap in the 1930s was 10 times larger than it is today. Financial crisis, 2008. So we always, we love comparing things to what happened during 2008, and from a more historical perspective, the Great Depression. The output gap during the financial crisis was 5 times larger than it is today. And really all that means is we're falling short of what GDP could be. Now we're seeing signs that may be turning around. But compared to previous recessions, we're still, 5 times less than 2008, 10 times less than the Great Depression. The reason this is important, however, is because the amount of money that is being thrown into the economy tells a completely different story. And
you mean the $1.9 trillion I alluded to before?
Right. So what we're looking at here is a chart of the red. I'm sorry, the blue is a measure of the money supply. So you can see it has sharply risen since COVID. Oh, that kind of, you can't really see that very well, can you? Sharply risen since COVID. And the reason this is important is because that sharp rise doesn't even include the new $1.9 trillion infrastructure package. There's still another $100 billion remaining of PPP money. So there's some $2 trillion plus not even included in this money supply figure. And at this point in time, we have plenty of data here. The new theory of creating money in an economy is sort of based on the presumption that if there's no price inflation in consumer goods, you're really not doing any harm. But the issue is this: we're seeing what pretty much comes out to almost perfect correlation between the money supply and the stock market. I mean, this is not a coincidence here. This is now over a decade of data, and the stock market just tends to follow the money supply when you have the Federal Reserve and the federal government utilizing both expansionary monetary policy and expansionary fiscal policy at the same time. We do have a little bit of a glimmer of what happens when the opposite occurs. So right here is when the Federal Reserve started to pull back from all the liquidity that was created to pull the economy out of the 2008 financial crisis. I know Rick remembers this because we were talking a lot about
that was October 2015, 2017,
2018, yeah. So quantitative tightening, which is the opposite of quantitative easing. As soon as they start pulling that money out, guess what the market does? Sharp correction right there. Christmas Eve 2018, Rick and I were putting a bunch of cash in the market because it was down almost 20%.
For no particular reason.
And the reason was because the Federal Reserve just barely started pulling out of the money supply, just barely. So this is something that, we've kind of adopted the theory of, just to dance while the music is still playing, because as long as there's cheap money still getting thrown sort of into the economy, it is likely, again, this is not a mistake anymore. This is over a decade of data that the market is going to correlate to that. And we're keeping a close eye on when the Fed is going to start to be a little more dovish and say, hey, we might need to pull back on what we're doing. But the recent comments are, we're just going to keep printing money. That's it, to infinity. So that certainly creates some longer term concerns, but at least for now, we're going to dance while the music is still playing.
To infinity and beyond.
Especially when you can't get yield out of bonds. Let's see. Okay. So we'll come back to some market stuff, but I just wanted to cover this piece because we did put this in the commentary. One thing we've been looking at a lot more on a tax planning side is Roth conversions, Roth contributions, really anything Roth. And the reason is this: tax rates right now for if you're kind of in the middle of the tax brackets, are at pretty much historic lows. So the 24% tax bracket, I'm gonna draw a box around this here. So through tax year 2025, this was enacted with the Tax Cuts and Jobs Act in 2018, which is set to sunset in 2026. Now, who knows if the people in Washington can figure out what they're doing, maybe they'll give us some guidance beforehand, but it's likely going to be something where we're not going to really know until the 11th hour. But at any rate, right now we know through tax year 2025, the 24% tax bracket, right? And I highlighted this here for single filers goes up to 157 in income, for joint filers 315. The reason that is important is because the sunset, and then in prior years, the 25% bracket is almost half of that. And the sunset means it reverts back to the previous tax brackets. There's also a huge jump. So 24 to 32% you jump from if you go over those limits. So we kind of looked into this from a historical perspective. If you use that 24% bracket, and just for argument's sake, $315,000 for married filing jointly of your taxable income. 2012, if you look at this chart on the left-hand side, 2012 we had the same tax brackets as what you see on this before tax year 2018 chart. What you'll see is that for somebody falling under the 24% bracket, your effective tax rate, your effective overall tax rate, is actually the lowest, because right now it's about 20%. It's the lowest it's been since before World War II. And that's important for a few reasons, the least of which being most of us would expect tax rates to go up in the future. And we don't know exactly what that means. The one thing with tax planning is you can't do much tax planning until you know what the legislation is. We can speculate, but what I know to be the case is that this is the lowest. If you have income under $315,000, married filing jointly, under $157,000, single filer, your effective tax rate is the lowest it has been since about 1940. So if we can pay taxes underneath that bracket, and more importantly, if those monies can go into an account that then grows tax-free, it is likely advantageous from a long-term perspective.
So what do we call that? A Roth conversion we're talking about.
So a Roth conversion would be pretty much the example of that, of creating tax-free growth for the future while paying a low tax rate today. And it could be a conversion, it could be a contribution. But this supports the thesis of it's a good time to be doing Roth, at least for the next, say 5 tax years. Here's another thing that sort of supports that thesis and veers off a little bit, but we're gonna talk a little bit more around real estate markets. But one of the things that's happening, we talked about, I guess back, what was it, Rick? Probably 2 or 3 quarters ago. As we were coming out of sort of the initial downturn from the pandemic, you heard economists talking about what shape recovery are we going to have?
No.
And what they really meant was, a V shape was one of them, which was, market goes down, market pops right back up.
Hockey stick.
Hockey stick goes down, kind of stays down like that. W
shape. Yeah.
So pops back up and then kind of takes another dip.
Which we actually thought was going to happen this time too. We thought it was going to be a W recovery.
Yep. Yeah, we talked about that a lot.
Yeah, a couple quarters ago.
And this is more from an economic sort of social demographic standpoint, but I think that this informs a lot of what may be coming down the pike. We're hearing a lot about the K-shaped recovery, which sort of doesn't make sense because you envision a K, right over here on the right there, a K. It's essentially referring to two disparate outcomes from the pandemic. So we had the COVID lockdowns and the crash. And then you had the central bank intervention, which we talked about, and we had the bounce back. And then two things happened, and we talked about this a little bit in the letter. But two interesting things happened. Number one was some jobs could be done from home and via Zoom, like we're doing now. And the interesting piece with that is we wrote about Zoom towns in the letter. There's actually vacation towns, more specifically vacation destinations, seeing huge growth in their real estate markets because people are moving in from out of state, from cities, and they just decide we're going to work here. I'm just going to work on Zoom now. And you see cities having the opposite impact. You know, you have a real estate boom in places like Manhattan and San Francisco, and you know, anyone who's been Rick's in Philadelphia right now, but you know, they've shut down in a lot of cases, and they haven't seen the real estate boom. Now, remote work obviously is what's driving a lot of that, but it's also from an economic perspective. So that kind of lower segment of the K are sort of, you know, your more blue collar workers, cyclical businesses such as restaurants, you know, small businesses. You have shops, you know, closing down their storefronts because, you know, nobody's on Walnut Street anymore in Philadelphia. So you're seeing that K, and I think, you know, then the next piece that may happen here is you kind of see that for on the upper part of that K, the pandemic kind of represents this those who have 401ks, who own real estate. It's actually been a boon. And then for that lower part of the K, for renters, for people in the gig economy, it's been the exact opposite. And essentially, it serves to contribute to inequality, and therefore, with tax rates at a historic low, you would think that this would only lead to tax policy discussions to revise rates to the upside. And therefore, it kind of goes to support the theory of, you know, if we can remain under the 24% bracket from a tax planning perspective, you know, that's sort of what we would be targeting. So,
Yeah.
Rick, I think you wanted to talk a little bit here about, oh, we got the real estate market.
I did hear, there was an article in the paper the other day, actually, that I should have actually printed it out, but there's the number one city, and I cannot remember the name of the city, but it's in Idaho. It's a city that sits on a lake. It's the number one city right now that people are going to, and what you're talking about, people going to live rather than in the cities. Zoomtown, yeah. And believe it or not, Trenton, New Jersey fell at number 40. I don't have any idea how that happened and why anybody would ever want to live in Trenton, but Trenton, New Jersey fell at 40.
Really?
So, yeah.
Interesting.
Yeah. So
I did see that about the town in Idaho. Yeah, it was the top town. Yeah. Yeah.
It's you know, we have clients that are actually moving out, that have moved and moving out to Denver, to Colorado. And Colorado is another big town. A couple areas in Colorado are big areas that people are moving to, along with Texas.
Yep.
So Texas and Arizona is on that top 10 list.
Yep.
So just found that fascinating. And when people are coming into these areas and buying houses, they're buying them with cash. So those who want to move into the house who want to move into those areas on a contingency basis, trying to sell their house and buy another house, are getting pushed out. So which we'll talk a little bit more about the real estate market coming up next. But just found that very interesting, that you know, how fast this is actually starting to happen.
Yep.
And once this market opened up again in the summertime, it just started kicking into gear. What was shut down in the wintertime from
Yep.
last year.
Yeah.
So,
All right. Let's move to the next.
oh, the next part is not real estate. Next part is the
Oh,
power of
dividends. Yeah.
dividends. Yeah, I've been looking forward to this for a long time. And I think, do we have how much time we have? We have time that I can actually tell my story about this.
Yeah. Yeah. Yep.
So anyway, Warren Buffett loves stocks that have reliable, reliable, sustainable dividends. Loves those types of stocks. Matter of fact, the top 10 holdings in his portfolio are dividend paying companies. I love this idea. Back in 2007, I call this my little old ladies portfolio. Back in 2007, I had three little old ladies, all in the late 80s, early 90s. They were all three sisters living together. And they had asked me if I would oversee their dividend portfolio. And basically, they didn't want me making any recommendations. They had the one sister there that was making all the recommendations. All she wanted me to do is provide her information and give her some feedback. Um, I brought in the portfolio. We oversaw the portfolio, provided reporting on the portfolio, and she hollered at me every time I gave her, some advice on why are you 100% in stocks, and they were literally 100% in stocks. There was no room for error. If this market went down, that portfolio was going down. Well, sure enough, they came after me pretty much like little old ladies would, and said, "I've been around longer than you've been alive. I've been in the market longer than you've been alive, and we think we know what we're doing right now." And so I backed up, gave them the room to do whatever they wanted to do, and sure enough, we rolled into late 2007 into 2008. Unfortunately, they had one stock in their portfolio, which was Wachovia, and which is now Wells Fargo. So it went from $59 down to a dollar. Wells Fargo bought them out for $1. That was their only loss. And in the worst part of the economy or the market at that point in time, from October of 2007 to February 2009, they were the peak to the trough. They were down 24%, where the market was down almost 60% at that point in time. So I learned my lesson on dividend stocks and what can really happen when you have good quality, reliable, sustainable dividends with good quality companies. Now, in 1987, Warren Buffett actually bought Coca-Cola he bought $1 billion of Coca-Cola in 1987. And he saw the opportunity with Coca-Cola. They were paying a dividend. Matter of fact, Coca-Cola has over 58 straight years of consistently increasing dividends year over year over year. So when Warren Buffett bought Coca-Cola in 1987, he bought $1 billion of Coca-Cola, and now today, that same $1 billion of Coca-Cola is now paying $500 million in dividends per year, which I find fascinating. So dividends build strength into a portfolio. So just these are we're actually bringing out our about a year and a half, almost 2 years of research, Dan, if I remember correctly, on building out this dividend portfolio. And we've been working on it for about 2 years, trying to find the right mix and where to pull the right companies from. We brought on a CFA back in early January. I think he started February 1st, if I remember correctly, who was also helping to pull this together. But just to give you an idea, it's the Warren Buffett thought process. Coca-Cola, again, 8% trailing 10-year return. In 2010, the dividend was 88 cents. And in 2020, the dividend's $1.64. Lockheed Martin, again, trailing returns. Lockheed Martin has been doing fantastic over the last 10 years, but trailing returns over the last 10 years, 20.8%. And the dividend in 2010, this is pretty amazing here, is they paid $2.64. And today in 2020, year end, they had paid $9.80. I'm looking for a double in a 10-year period, which I think is fantastic. And the dividends that we're looking for are growing dividends year over year. That's a 7% increase if we can get a double year over year. So we're keeping up with inflation. And then we have Air Products, which had a 15.72% return over the trailing 10 years and paid a dividend of $1.96. And in 2020, that dividend was $5.36. So we're looking for good quality, blue chip type companies with lots of free cash flow and the ability to pay their dividend over and over again. They have good, reliable, sustainable dividends year over year that increase every single year. And they have good ROI. So part of their money, part of their free cash flows, they go to pay the dividend. The other part, they can do a buyback on stocks, they can pay down debt, and they also reinvest in their company. And we want good, strong ROI, which you can see in Lockheed Martin and Air Products. Their ROI was very strong and had some really nice returns over the last 10 years. But these are just 3 different companies that we have selected out of now a portfolio of 15 dividend paying stocks that we're going to be rolling out and talking to everybody over the next year about, having a small piece of this within their portfolio so we can build strength in that portfolio. The other thing dividends do is when we're in an inflationary market, interest rates, are going up on a regular basis. You're in a bond portfolio where that bond portfolio is being chipped away, and you're getting better returns, but from a dropping dividend or dropping value in the bond portfolio. So dividends play a role, although they will be affected from time to time in the volatility, but they play a large role in an inflationary market where we're consistently getting increasing dividends, where in a bond market we can't do that. So this will build strength into the portfolio and build an income into the portfolio. And the other part, Dan was talking about taxes a little bit earlier in the dividend. When we look at qualified dividends are at a 15% tax bracket. So you're paying 15% tax on qualified dividends, which is very inexpensive. So you can be in a much higher tax bracket and still only pay 15%. So Dan, do you want to say anything about this portfolio and where we're going with this? Some of the things we've talked about in the past?
I would just add, I think, Rick's going through a couple specific examples. He said, as he mentioned, and I'm happy to share, the full list of the 15 companies stocks that we're looking at. But we're kind of looking at this as if it were kind of your own personal income statement. So what we've done is looked at companies who have a payout ratio, meaning their free cash flow is covering the dividend, and they still have money left over. It's very important. And they have at least 25 years of never cutting the dividend. And the reason that's important is because 25 years would start back in 1997, Rick, did we start? 1996. So we wanted to capture basically 2 bear markets.
Yeah.
And the reason that's important is twofold. This is why you should care about it. If you're retired, you still need income if the market's down. And this is the dividend per share. So we often think of dividend as a certain yield. Oh, we're getting a 2% dividend or a 3% dividend. We make sure that the company did not cut their dividends per share. So that's very important. The market's down and you still need income. Also important, if you're not retired yet, still growing your portfolio. If the market is down and you're reinvesting dividends and they have not been cut, well, then you're dollar cost averaging back into the market with those dividends at a much higher clip. So something to think about. It's, as Rick said, it's a part of the portfolio, but what we like about this is sort of our answer to, we want to stay invested, dance while the music's still playing, can't get yield in bonds. So this is kind of a conservative play to stocks. that we think is going to be really important to portfolios moving forward, because growth has outperformed over the past decade plus, and we think there's going to be some reversion to the mean there.
Yeah. And the thing with dividend stocks, as we talked, Dan, is they're boring. So
Yeah.
they just putz along in the market, and they don't give you, in a lot of cases, they're not going to give you knock the cover off the ball returns. And when this market is rallying aggressively, these stocks will underperform that aggressive rally. When these stocks,
Coca-Cola, 8% trailing 10-year, nothing to write home about.
not at all. But an increase in dividends by 7% every year. You beat inflation.
Yeah, pretty good. Yeah.
So that's the fun part. But in really aggressive markets, you won't see this part of your portfolio going aggressively up. So we do want to diversify. Obviously, when you're more aggressive, we're going to put a little bit more growth in the portfolio. When you're less aggressive, we care more about the income. And as you continue to get towards retirement, we care more about the income and the income growth. And coming out of, and I remember well coming out of the tech market in 1999, where dividend value was almost completely obsolete, because you couldn't get a return out of anything that was dividend value oriented. Well, guess what? As of March of 2000, the tech market crashed, and then for the next 8 years, dividend value was the biggest play in the growth in the market over that period of time. So, and you can see that play out on some of our charts that we have in when we went through the research of this.
Yeah.
So, which we'll share with you on an individual basis. So, so very excited to start rolling out some of the dividend portfolio and how we're going to put it in your portfolio and how it's going to fit. It doesn't fit everybody all the time, but it fits a lot of people most of the time.
Yep.
So that's what I got to say. This is the other exciting piece. We got about 15 minutes, and real estate market. So we've seen the real estate market just aggressively going, and some people know, and other people don't know, that I sold my house in Cherry Hill. My wife decided on Facebook. She had a inquiry come across Facebook. Somebody was looking for a house for a 4-bedroom house with a decent sized yard and a pool. And since my kids moved away and they don't come back as much as we would like them to, and use the pool, my wife decided it might be time to sell the house. So they came walking into our house. We heard their story of actually they've bid on 4 different houses over the last couple of months of trying to find a house. And it was a young couple. And they got outbid, they got outplayed with cash, and they lost 4 different houses. So they walked into our house, and the first thing the young lady said was, "I can see myself baking Christmas cookies in this kitchen." And I rolled my eyes at my wife, and knowing that they were going to come back with an offer. So they made us a big offer that we couldn't refuse. And since our life is moving on, my youngest daughter is going to college this year. We decided to make the move and figure out where we're going to move next. So that's how the real estate market is moving. It's moving that fast, where people are trying to make private deals through Facebook. And if you look at this chart on the right, you can see the top right. It's the Schiller Index, pricing index, where you can see from 2000, it looks like 2014, we had the lowest part of that market, and it just started clicking up from there. Where real estate pricing has just continued to go up and up and up. And again, you can see this a lot now in places like the Shore, Colorado, some of the places we've already mentioned. The prices are going up 50, 25, 35, 45, 50% in the market. When you look at the market, the chart down on the bottom left side shows single family houses in the yellow, and it shows existing home inventory in the purple there. And you can see that the single family homes for sale has actually dropped down. And main reason is those who are willing to sell their house have sold their house, And those who are not willing, and a lot of this has to do with COVID, from what I understand, they're still not ready to show their house. So that market has actually dropped down, and the existing home inventory has stayed very stable. So this is what's continuing to drive prices up. And when you look at new home building took a spike after COVID, but it hasn't yet surpassed where it was before COVID. And this is where we were talking about a lack of inventory. So again, this is what's driving prices up. The problem with prices going up so aggressively in the market right now, especially in real estate, is it pushes people out of the ability to buy a house. The average home in the United States right now is about $300,000, and we need the earnings to go up, people income earnings to actually go up to help people afford to buy the houses. But what we're looking at now, I just picked up this article, I think it was yesterday, and the article is said, is the U.S. housing market actually heading for a crash? And what this goes to talk about in the potential crash that they're identifying here is there's 4 million homes short of being able to meet the current demand for buyers. Again, you can see that in the Schiller increase there in the top right chart. And this has grown over 50% since 2018. But what has happened in the COVID world, in the COVID crisis that we've been in, we also have 4 million Americans who are in forbearance in their mortgage. So there's millions of homeowners have since exited the forbearance and successfully have resumed their payment, but there's still as of mid-April, there's still 2.3 million people who are skipping their mortgages on a regular basis. And Joan Trice, CEO of Collateral Risk Network, it's an organization in real estate appraisal. She came out and said that having those homes actually go into default once the forbearance is lifted. And by the way, not only is forbearance lifted, but there's also, the government has extended the forbearance program and foreclosure moratorium through April so far, and it's continuing to be extended. So houses cannot be foreclosed on. But what she's indicating is the fact that if these houses actually come out on the market and they do foreclose on it, that could actually push it. That could actually push this market into a potential crash, where there's a lot of inventory back out on the street again, that may be even too much. And I can actually see that where if increases in housing market, in new homes, increase substantially, and this happens. Dan and I were talking a little bit about this before the Zoom meeting on quarterly conversations, and one of the things that we were talking about is will this be short-lived, and the potential of this being short-lived with the millennial generation being actually 3% greater than the uppie generation. Is that what I called it, the uppie generation?
Yeah.
But anyway, the millennial generation is 3% greater than the baby boom generation than we had, and that actually pushed real estate markets up in the early 80s, as inflation continued to go up.
Well, right, and it's demand. It's the demand,
yeah. And we still have not seen a lot of these millennials coming out onto the market. We're starting to see them now. The millennials that are actually making a decent amount of money, but we have not seen the large flux of millennials coming out onto the market to buy houses at this point in time. So if there is going to be a crash in the mortgage in the real estate market, we do believe that it could be potentially short-lived. But when these forbearances end and when the moratorium ends, it's going to be interesting to see what happens at that point in time.
Yeah, and we have to remember too, all this is being driven by demand. So in theory, from an economic perspective, it makes sense that prices are being driven up. Now, Rick put a chart in here about building permits and housing starts, and you see the spike back up. And he mentioned, not quite to pre-COVID levels, but it, spiked back up. Builders are trying to meet demand. But the thing to remember too is not only with COVID moratoriums, with interest rates, lending standards right now are not exactly stringent. There is a lot of money out there on the street that is just waiting to be lended, and this may not be and this may never be an issue, because we know that back in 2008 there were some other things happening. But typically with real estate, bubble type scenarios happen due to debt issues. Now, Rick mentioned forbearances, which obviously is concerning, that we're seeing large forbearance numbers when you still can't even meet demand. And, mortgage companies are treating their cash as if it's on fire, while prices are continuing to go up. But a lot of the real estate market does have to do with that debt picture, and we can see just from this chart on the bottom left, the inventory. There was a ton of demand leading up to 2008, and you can see that the inventory eventually did meet that demand. So the question becomes, if inventory does meet demand, you could see prices starting to plateau. But then what happens with the debt being used to finance that demand? Because right now it's plentiful out there. There's plenty of loans to be had. So from a practical planning perspective, if you have a mortgage, you haven't looked at the rate, might be a good time to, because rates are at all-time lows.
Yes. I got a couple of questions coming up when you're ready, Dan.
Oh, we do? Oh, yeah. Let me pop that open.
There's one question. There's actually a couple. I'm going to answer the one on the homes first.
Yeah, let's do that.
We're talking about
we got 5 minutes here. Yeah.
And as far as new homes go, and selling your home and simultaneously purchasing another one, is the scenario where housing prices could drop due to foreclosure or moratorium being lifted. Sometimes, is it something to wait for before buying, or not as important because you're also selling your home? Well, I can tell you, if you're selling and buying a home, it really doesn't matter, because you're going to be selling your home into a current market that's currently up, and you're going to be buying another home in the currently high market. And if you do decide to sell when the market's down, it's the same thing's going to happen. Is you might have more to choose from, but ultimately, if you really want to take a gamble, like my wife decided to with the sale of our house, is you can sell when the market's high and just wait it out and see what happens. And that was not on purpose. It was just because we had the opportunity. So we're not waiting it out to see what happens. We're just waiting it out to see where the world is going to end up going to over the next year or so, and where we might want to go to next. I'm kind of thinking being in Pennsylvania is more fun.
I would say on the buying side, from what I'm hearing, it's so competitive to the point where we talked about Zoom towns. People are buying houses on Zoom. They're dropping inspection contingencies. They're doing crazy stuff. I mean, it's really frothy out there.
Yeah. So the question came up: is it silly to sell and then rent? And I would say I've seen some people do that in the 2007 market. There was a couple of analysts that I know out in California actually sold and decided to rent a house that they could live in. And he did it because he saw how fragile the mortgage market was. And is that silly? I think if you're looking for a place that you want to live and it's not the house that you're in right now, it's opportunistic. I don't know whether we actually can time this market. I don't know how far down this market can go on a crash, because we have, again, that millennial generation coming in behind. So we don't know what's going to happen there. But again, there could be potentially more inventory opportunity available when that market does go down. And Dan, you want to touch on the the other question?
I got, let's see.
The inflation?
Oh, inflation. Lumber prices are going sky high. Yes, they are. Inflation will eventually have to hit. Well, so you are not a modern monetary theorist, because modern monetary theory basically thinks that inflation doesn't exist, which is silly. But inflation will eventually have to hit. Should a portion of our portfolio be in precious metals? Here's our attitude on precious metals. It is speculation. So if you're going to own precious metals, own the metal and own a good safe.
And hope that you can give it to the next generation.
Yeah.
And you won't need to use it, because if we have to start using those metals, then you have a lot more to worry about.
Right. And then we have another one here.
It says with the current administration. So let's just step back into inflation too. So inflation, two good things to be in when you're in inflation is property is one. Property values can continue to rise in inflationary environment. And also, again, in income paying dividends. Income dividend paying stocks is another good place to be during an inflationary market, in addition to taking little speculation and holding the actual gold or silver itself. And the other one, the current administration will be changes with death taxes. What is our opinion regarding with estate planning? Yes, there will be changes. With regarding to estate planning, I think we got to play with what we have now until we understand what's going to happen next.
So this is the same. I made a comment about tax planning earlier. This is the same thing with tax planning. We have to remember this type of legislation is never retroactive. In other words, there's always a window of time before it comes into place where we know what the rules are going to be and moves can be made. So my opinion is that it seems to me that the $3.5 million exemption amount seems to be a bipartisan number for whatever reason. They raised it up to whatever it is now, $11 million.
11 million and change, yeah.
Yeah, and they gave you the portability. It used to be that you could, port over like $1 million from a spouse's unused exemption and tack it onto your own. But for whatever reason, the exemptions went sky high, and they have, now you have full portability. And for some reason, just I don't know, legislators seem to just always come back to I guess, what was it? I think it was the pre-2009 numbers, which was 3.5 million. My opinion is that we're going to be back to 3.5 million, and they're going to do away with the step up in cost basis. I wouldn't do anything based on that opinion, because like I said, these types of things are never retroactive. We're going to know what the rules are, and then we're going to make some decisions based on what those new rules are. But I would anticipate some changes coming down the pike. Yeah.
Yeah. That they do plan. That's one thing that they really plan on doing is not giving you a tax break on a step up in basis. That's been talked about quite a bit through two administrations, actually three administrations at this point. So for quite a few years, it's been discussed. So I think we're at our 5 o'clock hour, Dan.
Yeah. Do we have any other?
I don't think we have any other questions, which is good. And we appreciate everybody taking the time and joining us today, and always looking for input. So when you have us on the phone, please give us some input, whether positive or whether negative. We can always cut things out. We can always add things to it. We're trying to mix things up a little bit through this, through the quarterly conversations. And I think that I'm going to shoot for Dan and I being at Dan's house in October's quarterly conversation, sitting in front of the fireplace. That's my goal. You didn't know that yet, Dan.
We could do that. Rick mentioned that he doesn't have his pool anymore. We could also sit out at the pool over the summer if you want.
We can do that. We can. That would be a fun place to have quarterly conversations.
Yeah.
So. Actually, I think this year is out. But I think a client event at your house, Dan, in the middle of the summer, because now you got that yard.
It's going to happen.
It's going to happen. I had to give up the opportunity because that was one of the things I really wanted to do when COVID hit. So now it's the ball's in your court. I think that's next summer's event.
We're gonna do it. We're gonna do it. It won't be virtual. That'll be in person.
That'll be in person without doubt. So, all right. Thank you everybody for joining us. We appreciate you taking the time. Have a fabulous day, week, and weekend, and we'll talk to you next quarter.
Yep. Thanks, everyone.